So why do stocks go up and down? Now, if you're here just hoping for a quick answer to this question, here it is. They go up and down for every single reason you can think of. Yep, an almost endless list of reasons. But if you stick around for the next 15 minutes or so, I'll explain what I mean by that. If you're new here, welcome. I'm James. I'm a full-time investor and former investment banker with over 25 years of investing experience. And on this channel, we talk about all things money. So let's get into today's topic. So clearly, everyone who follows stocks, and especially those curious about the stock market, can't really go a day in the market without asking, why did this or that stock go up or down by that much today? And in most cases, there is a reasonable answer to that question that will explain the majority of the move. The key issue, sadly, for most of us, is how quickly you, as a stock investor, can then find the answer to this question, and then obviously use that information to your advantage. Now, clearly, I have to mention the obvious. The reason stocks go up is because there are more buyers than sellers, and vice versa. Stocks go down because there are more sellers than buyers. But that is the most simplistic answer. So the real question behind that is, why were there more sellers or buyers today? So let's answer the main long-term fundamental reasons why stocks go up and down. Reason one, fundamental company information was released. News about earnings or revenue or debt levels and big management decisions affecting the future direction of the company, or even, let's say, changes in management themselves, like a new CEO, for example, all affect investors' views. And as I've mentioned before, companies officially announce this type of information on a quarterly basis during 4 quarterly earnings cycles or earnings seasons, roughly every early February, May, August, and November. But they also sometimes pre-announce earnings, a profit warning, for example, or occasionally make other material announcements throughout the year. Now, on the topic of earnings, most would think strong earnings typically means more demand for the company's products or services, and then growth in the stock price must occur. And obviously vice versa, poor earnings and investors sell and stock prices go down. Well, this is certainly what probably ChatGPT and other answer engines will tell you. But if you've ever watched an earnings release and seen great profits announced, to only then see the stock go down, or vice versa, you will know this is nowhere near a rule to follow. The actual answer is hidden in reason 2, future expectations. So what actually matters is a fundamental company performance relative to what all the existing investors are expecting at that moment for the future of that company. So are earnings expected to rise by 10% or just 2% or perhaps 30%? So before an earnings release, this is often called the WISP number or the consensus number, or more generally, just the market's expectations. So it comes down to a comparison of reason 1, fundamental performance, relative to reason 2, expectations. And this is one of the most important drivers in stock moves, especially over the long term, because this is the primary driver for long-term investors to invest or not, and typically long-term investors drive long-term trends. So then you might ask, well, how do you find out what are expectations? Well, sadly, it's not always easy, and there is no precise answer, because you can never really know every single investor's expectations or needs or wants for their own money in every single moment. So kind of the best we really have access to is most of the time the big investment banks and also the individual companies themselves often try to collate expectations from the big major investors and share around an average consensus number for the market to then know about. Also, investment banks publish their own expectations on platforms like Reuters or FactSet or Bloomberg and share them with the big market news networks like CNBC or Reuters or Bloomberg. So then everyone can kind of get a rough consensus on expectations that can then be used. So you need to look out for this information every quarter. Now, moving on. Reason number 3, economic conditions. This is another huge factor. The biggest of these is often changes in interest rates. Now, for example, at present, roughly 85% of forecasters are predicting a 25 basis point cut in the Fed rate at the September 17th meeting next month, so a quarter point. This is providing support to bullish investors, as typically lowering interest rates leads to improved economic conditions and thus higher stock prices. Now, along with this topic, an even bigger factor is the change in direction in interest rates. So if the central bank, the Fed, as my example often goes, was to change from currently cutting interest rates to then hiking interest rates, this is a much bigger change than a continuation of an existing trend. So really, when we're looking for a continuation of an existing trend, we're actually kind of looking for an end to the trend, because that change in trend is really where a lot happens, and a lot of sentiment can then be built off that. So you really need to watch for rates, as obviously this is more of a substantial influence on future economic conditions. And hence why the words used and the tone during these central bank meetings are so heavily scrutinized and debated. Now, other big pieces of data are inflation, unemployment, and GDP, to name just a few, which all provide insight into economic conditions, which in turn help investors forecast a company's ability to generate profits. So, we all need to be aware of high-profile economic data releases, and of course, when the US central bank and other central banks which are relevant for our investing are making their key interest rate decisions throughout the year. So now moving on, let's discuss the main short-term reasons which impact stock moves. Reason number 1, market sentiment. What does this mean? Well, are the majority of investors bullish or bearish? Where is the market currently trading? At all-time highs? Probably an indication that investors are rather bullish, like right now, for example. Or have we had a 20% pullback down like we did in April? Probably a good indication investors have turned somewhat bearish. Then you can also look at what is the market valuation, a price to earnings multiple. Is the market or the stock expensive relative to history, or is it cheap? Market sentiment is a huge driver for short-term moves. So if the market is at all-time highs and some negative piece of news comes along, like what happened in April, the market can fall very, very quickly because it's a substantial change in direction to where the sentiment is already positioned. And vice versa, if it's had a big sell-off recently and good news comes out of nowhere, it can rally very, very quickly, as obviously also happened when Trump delayed his tariffs. Now, this also means when market sentiment is very bearish, for example, and then negative news comes out, and the market does not go down lower or much lower, well, now you have a strong signal of support. Just as when at all-time highs or relative highs, and positive news comes out, and the market no longer continues to rally. Therefore, having an idea of current market sentiment is very important, as it can drive individual stock moves. This can mean when an individual stock has good news or bad news, if the market sentiment on that stock or sector or the whole market is counter to the news that should have impacted the stock, so good news means the stock should have gone up, etc., but market sentiment is now very negative, then it can, supersede, override the specific news. And whatever the relevant news is, good or bad, can sort of fall on deaf ears because the sentiment is overwhelmingly biased in one direction only. Reason number 2, external shocks. So things like natural disasters, wars, sadly there are a few at the moment, pandemics, or sudden shifts in policy can all create significant volatility in individual stocks sectors, and of course the overall market. With a great example of this being back in April this year, when Trump substantially changed economic conditions globally with his far bigger than expected tariff proposal, and it kind of sent stocks into a massive nosedive. And then the reverse happened when he delayed them, and we rallied 12% in a day. Another great external shock example was obviously COVID-19 back in March 2020 or so. Now, sadly, all of these external shock events are much harder to prepare for, and generally, you must just accept they are kind of part of the investing cycle. Now, reason number 3, unknowable reasons. Finally, kind of the most annoying category. Sadly, there are also the countless other, sometimes insignificant, and worse, totally unrelated reasons which can affect any single stock or even an entire sector. For example, a big pension fund manager needs to raise capital. They've decided that they want to buy something in this sector because of some fantastic news, whatever. They then need to raise capital to do that because they're fully invested. So they have to sell something. They choose to sell everything in this sector. And because they now want to go here, because they're allowed to do that and they change their mind. So now they have a significant amount of selling, billion, 100 billion, who knows? The amount of money these guys move around is insane. So then they sell down that existing position in a particular sector, or stock maybe. So then all we see as investors is there's a noticeable downward pressure on a stock or a sector without any relevant negative news, no matter what we look into. And sadly, this can persist for many days or weeks, yet there's just no real good reason. Now, this does not mean that stock has had bad news. But relatively, that particular one fund manager found something else to invest in, and there are thousands of fund managers all moving billions of dollars around. So this also happens to a more extreme extent when an entire fund fails, or to a lesser extent, is simply closed down. And this can all happen for so many different reasons. Sadly, as I say, this final category of reasons is rather long, and by far the most annoying, as kind of often you never really find out the answer explaining a move. So in summary, there are many reasons that drive stock prices. Typically, the short-term moves are driven mostly by news, rumors, market sentiment, and all sadly rather unpredictable and hard to prepare for. Whereas, over the long term, it's typically driven by company fundamentals, things like earnings, innovation, competitive advantage, new products, whatever, and management quality, and of course, overall economic conditions. So you must be aware of earnings release dates for any stocks you invest in, and get prepared to update your view based on the data the company provides, and also be aware of the release schedule of major economic data and interest rate decisions. So good luck out there, folks. I would like to thank you for watching. And if you like my content, please consider hitting the thumbs up button and sharing this video, as it is free to do so and the best free way for you to support my work. And stick around for a few seconds to watch another great video I've chosen just for you. This is about financial advisors and you taking charge of your own financial future. So check that out here.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.